What's up everybody? Welcome to the Stocks channel. My name is Corey and today in the stock market we see a pullback across the board in the indices as we are now coming back from the low volume Thanksgiving holiday week and it looks like the bears are back in town. First up, let's take a look at the S&P 500 SPY ETF. So let's crack open this chart and see what's going on in the stock market today. Alright, I hope you all had a great holiday week and enjoyed the time off. And a quick reminder, the Black Friday deal for bank trade alerts is still going on for the rest of this week. Alright, so today in SPY we were down 1.6% and we see SPY is back down below the 5 EMA. And we did get a gap down open, so we do have another gap to fill to the upside just below 402. So we can very clearly see the bears are back in town after that low volume week we had last week. In just one trading day, we have completely erased the low volume melt up that we had from last week. So we clearly see the bears are still putting pressure around this negatively sloping 200 simple moving average. So this is going to be a very critical resistance zone right here at the 200 simple moving average at 404. All the way up to the gap close at 408 and the resistance trend line that defines this bear market, which is now below 410. Because that is a negative slope, it will continue to decrease each and every day. So if you're a bear, you're setting your risk up here at any of this resistance above. And as a bull, you have this last line of defense, which is the support trend line and the rising 20-day simple moving average, which is going to be right around 390 all the way up to about 391. So yes, the bulls are still in it while we're above 390, but we still do have a little bit more to drop before we test that support. And if the bulls lose that support, the bears will try to push for the gap close at 381. So this is still a trading range on SPY between 390 and 400. And you do want to wait for the breakout in either direction. And now that we're through the low volume holiday week, we are very likely going to see volume picking up, which is going to make the next move in this market a lot more explosive. So if you just go back in time over the last 2 weeks, we've just gone absolutely nowhere, breaking out after that CPI data report and then just trending sideways as we digested that huge volume day. So if we just do a quick recap of the last 2 weeks, we know the bears were obliterated after the CPI data and they have been spending the last 2 weeks covering their short positions. And we do know a lot of people are becoming more and more bullish the longer SPY continues to hold up at these levels. But that does not guarantee that we are going to break out of this consolidation in the bullish direction. So you do need to watch the trading range between 390 and 400. The bulls are getting a lot stronger while SPY is above 400, and the bears will be getting a lot stronger if they can break SPY down below 390. Below 390, we're looking for the gap fill at 381, and above 400, we will be looking for that gap fill at 408. But we do need to be mindful of that very strong resistance at the negatively sloping 200-day moving average at 404. So remember, we're in a bear market longer term below a negatively sloping 200 daily moving average, but in the short term, we do have this bull trend of higher lows and higher highs. So you will want to respect the short term uptrend. And if you're waiting for confirmation to get more bearish, it's going to be the breakdown of that support at 390. On the Nasdaq 100 triple Qs, we were down 1.47% today, and the triple Qs are still stuck in that trading range, which is going to be between 282 all the way up to about 293. We know the big bad bear is waiting at 293, so that's going to be the critical resistance the bulls need to break. And on a break of that resistance, we will be looking for a push all the way back up to the 200 daily moving average, which is at 306. And the potential of that gap fill at 308. We do have this confirmed double bottom breakout as long as we're above this neckline of resistance, which is going to be the zone between 280 all the way up to about 284. So you can't rule the bulls out as long as we're above this support, which is going to be right around 280 on the triple Qs. Below 280, things look a lot worse for the bulls and we'll likely see the bears driving us all the way back down to fill the gap at 268. And if we do see the bulls pushing back over 293, then you can get a lot more bullish for the gap fill at 308. As you can tell, the triple Qs are relatively weak, especially when compared to the Dow Jones. So when you don't see the tech sector leading the way, there is very little reason to be expecting a very strong bull rally. So you're going to want to see the big tech stocks looking a lot stronger, which should push the triple Qs higher if you are expecting a bull run. But there is no way we are getting a strong bull market if the triple Qs are looking this weak. On the Dow Jones, we were down 1.46% today, and you can see we had that very low volume melt up over the Thanksgiving holiday week, and we did get the break of resistance around 342, but we instantly erased that low volume melt up with just one swift motion to the downside with today's trading, and we're right back down to the support zone right around 338 to 339. In the Dow Jones, we're looking for a battle of the gap situation, and we're looking to see which gap is going to fill first, with the bulls trying to fill the gap at 347 and the bears trying to fill the gap at 331. So if you want to get bullish, wait for the break of that 342 zone, which should take us up to fill the gap at 347. And if you're trying to get more bearish, wait for a breakdown below about 337, and that should send the bears back down to fill the gap at 331. On the Russell 2000 IWM ETF, we were down 2.02% today, and you can see that very clear rejection from the negatively sloping 200 daily simple moving average, which was that resistance we hit last week, which was just below 186. And right now we are sitting right on top of the support trend line, which is just below 182. If the bulls lose this support trend line, the bears will push for the gap fill at 178. And below 178, we're very likely coming back down to retest the daily low around 174. The bull breakout above 186 should take us back up to resistance around 190. On the ARKK ETF, we were down 2.81% today as ARKK is getting rejected from that resistance zone right around 36.5, and we still haven't filled the gap to completion, which is down here right around 34, even though we did get very close to filling the gap last week. So remember, the ARK ETF is in a very strong bear market with a gap to fill to the downside, so it is very likely that we are going to fully close that gap before we can go any higher. And if we close that gap and continue lower, you're looking for a retest of the low at 32.5. On a break of resistance at 36.5, you'll be looking for a retest of resistance, which is going to be right around 38. On the VIX, we were up 8.34% as we see the VIX is starting to bounce up from that support zone right around 20. And we did fill the VIX gap, which was all the way back here at 21 with last week's trading. But we did open another VIX gap with today's gap up, which doesn't fill until we go back down to VIX levels of 21 yet again. So remember, these VIX gaps will get filled, but we have no idea when. So right now, respect the fact that the VIX is getting a sharp bounce off of the low right around 20, which is exactly where the VIX has been bouncing all year long, and that is where the bears have been stepping in. So respect the fact that we're seeing a spike in volatility off of this level at 20. The bulls will need to drive the VIX all the way back down below 20 to say that fear is leaving the market. But right now, that is not what we see, and we're starting to see the VIX bouncing off support. On Bitcoin, we're currently down 1.26%, and Bitcoin is still looking relatively weak with the price action below all of the moving averages and sitting right around this support zone at 16,000. If we lose this support, the next price target to the downside will be 14,395. And if we break out of the resistance, which is going to be all the way up here at 17,550, then we should see a retest of the breakdown of support at 19,000. But overall, we're still in a bear trend, and this does look like a bear flag getting ready to push for the next leg lower, which is going to be confirmed on a break of support just below 16,000. On Amazon, we were up 0.58% today, with Amazon trying to break out early in the morning, but getting rejected around that resistance zone just below 97, and the price action is trading right back down below the negatively sloping 20 simple moving average. From here, it looks very likely that Amazon's rejection is going to lead to the gap close right around 89, and on a breakdown below the gap close, look for a retest of the daily low at 86. Below 86, that does open the door for the next leg lower, with the downside price target at 77, and the upside resistance remains 97 and 102. On Microsoft stock, we were down 2.32% today, and Microsoft is starting to look like a double top rejection around 247 if we do start to break down below the neckline right around 241. Below 241, it opens the door to close the gap at 228, and below 228, we could go all the way back down to retest the low at 214. The upside resistance levels are going to remain 247 and 252, and you're getting a lot more bullish if Microsoft can break above 252, because that should send us all the way back up to close the gap at 265. On Nvidia, we were down 2.72% today, and Nvidia is also starting to look like a potential double top rejection from the resistance right around 165 to 166, but we are still above the support level, which is our risk level as bulls at 156. On a breakdown below 156, we could come all the way back down to try to fill the gap at 142. So just get a lot more risk off if we start breaking down below 156. On a breakout above the resistance at 166, look for a retest of the resistance, which is all the way up there at 179. On Tesla stock, we were flat on the day, only going up 0.03%, and we did see a rejection around that resistance trend line around 188, and we are still below the negatively sloping 20 simple moving average, and we do have a gap to fill to the downside at 171. So stay risk off around resistance until we get a confirmed bullish breakout, because we could be going lower to fill the gap before we go any higher. So you will want to respect that resistance right around 188 all the way up to about 197. If we do get the bull breakout above 197, we could run all the way back up to 230, but wait for the bullish confirmation. If we continue lower after the gap fill, look for a retest of the low at 167, and then the next downside price target will be 163. On Apple, we were down 2.63% today, and we did see Apple losing that very critical support, which was right there at 146. And not only did we lose that support, but we also saw it acting as intraday resistance. So with Apple losing support at 146, it opens the door to come down here and fill the gap at 138. And if we close the gap and continue lower, look for a retest of the low at 135 and a potential closing of the gap at 133. The upside resistance that's critical will now be 146 and 150. And we're not getting bullish on Apple until it can start closing back over 150. On the financials, we were down 1.72% today with a sharp rejection from this resistance right around 36, and we still do have this gap to fill all the way down here right around 34.3. On the industrials, we were down 1.82% today, coming right back down to this support zone right around 99.5, and we still do have a gap to fill at 97. The healthcare sector was down 0.75% today, still closing above all of the moving averages and still in a very strong bull trend. The energy sector was down 2.74% today, gapping down and closing near the low of the day and sitting right on top of this critical support zone, which is right around 88. You can stay bullish above 88, but instantly need to get risk off if that support level fails because we do have gaps to fill to the downside. Don't forget, if we bounce off 88, there's also going to be a gap to fill just below 92. So jumping back over to the S&P 500, this is going to be a very critical week of price action trading because the holiday week is over and we're going to see volume coming back into this market, which is going to give us a good idea of where we're going to go from here. We have the possibility of a leg higher or a leg lower because we are still stuck in a trading range. So wait for the confirmation of the breakout of the trading range, and then you will know exactly which direction you should be trading in for the next leg in this market. No matter which direction it breaks, make sure your trading plan is prepared for either scenario, and then just let the price action do the rest of the talking. Also, don't forget to take advantage of the Black Friday special deal off Bank Trade Alerts where you can get 50% off 2 months of Bank S Plus or Bank. All you need to do is apply the coupon code Black Friday at checkout. Bank is absolutely crushing the market, beating all of the indices, including the TQQQs and the SQQQs, which is the only thing Bank trades. So take advantage of this special Black Friday deal now and try out Bank if you haven't already. And keep in mind, this is a limited time offer that will be expiring at the end of November. If you're looking to become a better price action trader, consider joining the Stocks Channel Trading Discord community where you get access to all of my intraday updates and analysis. You can find out how to join the Stocks Channel Discord by clicking on the link below. So thank you for watching, everybody. I hope you're crushing this market. And as always, I will see you in the next episode.